you got to meet the terms of the underlying deed of trust, the deed of trust that is signed and executed and secures the note. In other words, the promissory note, the promise to pay that loan back. And you're promising that you're going to satisfy that underlying deed of trust to the house. In other words, you're going to pay that mortgage note. And so that the exiting spouse is not going to get dinged on his or her credit because a payment is late. Well, there's a couple of problems. One of them, the biggest, is that by the time the payment is late, that's what triggers this remedy document, this deed of trust and secure assumption. And it says if the house spouse doesn't make payments or defaults on that deed of trust and the promissory note, then the exiting spouse has the rights to foreclose their interest on that property. Nobody knows how to do that. I mean, nobody in the general public, and many people in the legal field don't know how to do that. That takes time, money. You got to know what you're doing. So meanwhile, the exiting spouse their credit gets dinged for however many months that house spouse is not making those payments. So that's why we call it a remedy. In other words, it gives the exiting spouse something that they can do. They can come back and say, hey, listen, you're not making payments.